Okay, so shall we crack on then? Let's go through these particular sessions. First off, I just wanted to share with you what's contained in the course outline, because all of this stuff's contained in the course outline, the program, the detail of the program. And let's get that out of the way so I can actually read my screen. So learning outcomes for this program is to understand financial and digital innovations. Now, it's an introductory program, so I'm not asking you to understand all of finance and digital tech businesses at an advanced degree. It's an introductory program, and as an introductory program, it's a descriptive understanding of the relevant financial and digital innovations. Now, we won't cover all of them, because there are things that are happening out there today that we won't cover because we just don't have the time to do it. But we will cover the most important ones. And so really, because it's descriptive, we need to know what they are, what they do, and the context within which they're able to extend their presence or impact upon international business. Okay. And we talk about financial innovations, and I talk about digital innovations, and what I'm implying is that there's a connection between the two. All right. Now, because this is higher education, and there is a lot of personal study and research, is that I'm expecting you to make some of these connections. All right, it's not me telling you stuff so that you can be right. That's not what works in higher education. Okay, is that when you go into higher education, you go to universities because you're reading a subject. You're not studying a subject, you're reading a subject, and there is a lot of reading that's involved in it. I know that, I get that. And I'll try and keep it down to the bare minimum as I possibly can do. So to that end is that what I've done is that I've been very explicit about core readings, and I've just said that they're either core or they're further reading. All right. The core ones are ones that I would expect you to do during the course of the program. Further reading, dip into them if you're interested. But you need to be able to do the reading so that you can embellish, you can complement what it is that that we are talking about. Could I produce detailed learning outcomes? I've already produced detailed learning outcomes. They're on the online learning materials, but I'm going to do it again today. We're going to go through the learning outcomes for each particular module. Okay. So describe the financial and digital innovations and their outcomes over time. So how they've developed, where they are at their current state. Critically assess competing theories of global economic change. Now, innovation in theoretical form leads to change. Okay. But what we've learned, and we'll come on to that in a minute, is that actually the change, because of the nature of uncertainties, those changes sometimes are uncertain. Beck tells us that, if you remember. But that's where the critical bit comes in. Rather than a assumed position that innovation leads to better things, better life, more money, whatever it is that we are critically challenging that as to say what really happens. And we are doing that on the basis of an empirical observation of reality, the data, the evidence, okay? Not just a theoretical position, but the theoretical position and the evidence, which then allows us to say whether or not the theory corresponds to reality or whether or not it's just up in the sky somewhere and lacks rigor and relevance. Okay, so that's what I'm looking for you to do. Engaging group work. Well, the engagement in the group work element is the face-to-face sessions and the discussions. It's very difficult for me to actually set up group work for you, although I'm sure that some others have already done that. But when you are in different time zones and different parts of the country and you're actually just engaging online, it's just something that I didn't want to do specifically. So the group working is the face-to-face discussion. So, you know, explore and develop critical thinking, because that's what we're doing when we're talking about the articles. How would you critique those articles and the points that are in there? And if you remember, there's kind of like a 3-point plan that we've looked at in terms of critiquing those particular articles. Describe it. What are the relevant theories? How would you apply those relevant theories to the article? Where's the evidence? and that's set out in the written assignment. And those of you that have not found the written assignment yet, it's actually on the Blackboard site and it's there for you to be able to look at. And then carry out the independent research and critical analysis. So this is a start, or it is your foundation in you becoming independent learners, because that's what higher education is about. And you'll expect to do more and more of that as you go through the years, okay? So it's not going to get to the point where somebody's going to tell you stuff and say, we just do that, that's right. Now, I accept that within the course of your degree in international business, finance, economics, is that you're doing a lot of quantitative stuff, mathematics, microeconomics, which might well be about looking at identities and solving identities and making calculations and something. So this one sits a little bit at odds to it, because this one is very much is a sociological kind of study of innovations and their impacts on business and international business. Now that's a good and a bad thing. It's a good thing because you can't be wrong. You can only compile an answer out of the evidence that you find, and you apply it, and you actually create an argument, i.e. make a point and explain it. Okay? So I won't be able to read anything that you write and say, no, that's wrong. Because if I don't agree with it, I don't agree with it. But if you've argued it and you've argued it well, then it's valid. Okay? So if you think about it in terms of a continuum of things, at one end of it, you've got objective reality, laws and science, natural sciences, and we can predict from those what's going to happen. Okay. And then at the other end, you've got the subjective element of it, which is about interpretations and opinions and investigations. So this is at that end of it. But what we're doing is that we're coming halfway along, if you like, by looking at objective evidences in order to back up our investigations, our opinions, and our views. Although you present them as being objective, you don't present them as being my opinion. In my opinion, don't say that in a paper, because we just don't. I'll talk about that as we go through the remainder of this program. Is that I believe, or in my opinion, is tending towards faith and not science. And we are scientists. It's just that we're social scientists. So does that make sense? That the difference between that and business studies has always been like this, I'm afraid to say, is that business studies requires that you become a jack of all trades, is that you have the objective abilities to look at the numbers and to make calculations and so on and so forth, but also to do the interpretive stuff at the other end of it. It's always the case within business. So if you have a background in science and somebody like me comes along, you go, what on earth is he talking about? And if you have a background like me and somebody looks at you and says, well, calculate the probability of this or look at the yield on that, you know, what are you talking about? Because it's not our training, it's not our background. So there is a tension between the two. And I get that and I understand that, and it does make it difficult. But that's one of the reasons why business studies students are sought after in the workplace, because you've been able to demonstrate a capacity to do both. Okay. So early stages, I know, but here we are for our starter to 10. Has anybody got any questions for me at this stage? Just shout up if you do. You can unmute yourselves and tell me what you're thinking. No, we're all good. Right. Okay, fine. Session 1. Do you remember that? All the way back in whenever it was. When did we start? October time or something like that, I think it was. And we started to talk about themes of stability and change and relating to innovations. And one of the things that we are really interested in this particular way of looking at things is that innovations causes change, but how much stays the same? What doesn't change? Okay, and that's an important question. And I think that as well is that I ought to point out is that the topics are not discrete subjects. They can be applied right across throughout the program. So you can take bits from here and you can amalgamate them for bits from there, because remember, it's interpretive. They're not discrete topics. They say, well, I'm examining you on this topic. So I think that sometimes, you know, if in A level, you might say, well, I know what, let's say just English literature. I know what the book is, and there are certain topics that we're going to look at in the book. That's fine. Or geography or something like that. Because this is higher studies, is that what we're expecting you to do is to demonstrate the capacity to take things and apply them to reality. Okay, so it's not, they're not discrete topics, they can relate to each other as well. And the more that you can bring them in together in order to actually develop something which is robust and something which is at depth, is you're going to get better marks. Now, let me just say something about some of the work that you guys have done already, is that people have fed back to me some of their written work that they've done on papers, on articles already. And by and large, I would say that it's of a pretty high standard. Okay. So if you've submitted something to me and I've responded back to you already, I think that you're doing a pretty darn good job. A little bit more depth and a little bit more interpretation, and you will be looking at very high grades. I'm absolutely convinced of it. For those of you that haven't submitted anything for feedback, you can still do it. It's up to you. It's entirely up to you. You can carry on doing it. And remember, of course, is that I will now start to see plans based upon your written assignments, and I'll feedback on those as well. Okay. So themes of stabilities and change. Innovations causes change, but what also stays the same? How do innovations work in our wider business environment and business and society? And so I asked, or the learning outcomes for this particular session was about demonstrating an understanding of a variety of models that seek to explain the relationships between technology and wider societal contexts. How does technology and technological innovation impact? How do they come to bear? What's the processes or how do innovations occur? And you can look at the sort of like I don't know, the mad machinations of the scientists and bringing science and innovations and so on and so forth, or you could look at it from different perspectives. And I presented different perspectives to you, and I'll go through what those are and what and the relevance of them in a minute. But we need to, rather than this assumption that innovation automatically does something good, let's try and understand the models that determine how innovations work within our society, within our economy, and within work. And then to compare and contrast those various models. What's similar between them? What's different between them? What sets them apart from each other? And then the simple description might well suffice in those particular matters as well. And then apply the models to a contemporary case study. And the case study was Anna Gross's paper about washing machines and white goods and so on and so forth. And really that paper is about social science, the social origins of technological advance, okay? Social shaping of technology rather than something deterministic. And we could argue about the relevance of determinism, and we could argue about the relevance of the social shaping of them, but there was plenty of information that was contained in that paper that would indicate that it's the social shaping of technology. Technology is not therefore aloof from society, it's embedded within society. In other words, we all change technology and innovations by our use of them, our thinking of them, our application of them, and so on and so forth. It doesn't just happen outside of us. So social forces like finance, like social norms and acceptances, narratives and stories all drive technological change and innovations in technology. So the key concepts that I was really wanting you to get to grips with here was Perez's talk on, or Perez's concept on, which is this one, okay, technological revolutions and financial capital. And what she talks about is how finance drives technological advance. But if you look in the book itself, she also references social shaping of technology. She's an adherent of the social shaping of technology. So that's the kind of like the common thread between this, is that one which says that technology is aloof and develops and shapes technology, that is aloof and shapes the society, and another one that says, well, no, society shapes the technology. So the causal interactions are different here. And we looked at World Risk Society, where similar sorts of things, similar sorts of stories and narratives and a conceptual point, but the difference here is that Beck brings in the notions of uncertainty. The future's uncertain. You can't know how these innovations will develop. And he points out that some of the innovations have created bigger problems than they tried to resolve in the first place. There's always worth thinking about is that there's two elements to this, to any kind of technological advance. And so therefore you're left with two specific perspectives related to the social shaping of technology and technological determinism. Economics sees technology in a deterministic way. Technology develops, you get total factor efficiency savings and so on and so forth, total factors of productivity, which leads to advance and so on, economic advance and so on and so forth. But is that the whole story? Okay, so this is a critique of that idea that technology leads to advances. And the key readings that I wanted you to draw your attention to would be Ulrich Beck's World at Risk, and Mackenzie and Whatman's article, which is the introductory essay, The Social Shaping of Technology. Remembering, of course, is that I gave you guidances on what you need to read. I'm not expecting you to read the whole book of Ulrich Beck's work, but I am expecting you to read the introductory chapter in it. Whatman's article I know is a little long, but nevertheless, it's probably about an extended chapter, and there's no real reason why you shouldn't read all of that. Not that you'll be in a position to be able to know it. I'm not going to test your knowledge on the whole of that article, but I might test your knowledge on whether or not you've understood the main premise of the articles. Okay? You don't need a detailed word for word or verbatim understanding of it. It's not like, you know, sort of, it's just not, it's remember where we are, introductory, and it's discussive. Or descriptive. Can you describe the articles? Can you apply the basic frame of the theories? Can you apply those back into a real life scenario? So that's the first one. All right. Number two was about the national, international, and the global. And here we started to talk about differences and different perceptions upon business systems and economies. And then we more latterly applied that to the global, globalization, because viewing globalization is that you get convergence, you get sameness. But actually what we did look at is that there are lots of different, is that there's no such thing as a capitalism. There's lots of different capitalisms all over the world. Is that pretty much every economy is unique in that respect, in a mix of its of social welfare tendencies or state involvement against private sector involvement and about free market involvement. Okay, and then on that you've got different perception or different systems that are running within which business works in as well, which creates all sorts of global differences. And one of the ways in which we can understand business is by looking at the cultural. And then I extrapolated that a little bit further on by looking at globalization and presenting theories of globalization, contrasting theories of globalization, but also relating that to out of those globalization theories is that what we can see is a globalization of the cultural, which allows us to extract from the cultural the economic by saying that actually culture shapes economies. By looking at the culture and cultural artifacts is that we get an understanding about the kind of economy and the way that the economy operates. So that goes against the idea of the globalizing tendencies where things tend towards homogeneity. Is that doesn't appear to be the case. There's quite a lot of difference within those, but there are, again, as in the previous one, there's going to be some similarities and there's going to be some differences. So the learning outcomes on this particular model, or this particular session, was about appreciating the complexity and referring to a business environment of a particular country. In other words, perhaps we are mistaken to say that this is a capitalist country. What kind of a capitalist country is it? As an example, the Nordic countries tend to be quite similar, but not the same, as against the Anglo-Saxon countries, which tend to be quite similar, but not the same. And then in parallel, you've got maybe the East Asian countries, which tend to be similar, but not the same. And then there is a movement within that of economies becoming or moving along a path of development, like China as an example. China sets itself up as a communist state, it opens itself up, it engages with the markets, and there's an argument to suggest now that Chinese state Marxist capitalism is moving more into a market-based capitalism. Hence the markets, banking systems, and so on and so forth indicates that China's moving towards or converging closer to the rest of the capitalist world, rather than the rest of the capitalist world tending towards China, despite its demonstrable successes. So we need to look at these things in a bit more detail in order to be able to make conclusions about the nature of business. Okay, business is not a catch-all thing where it's the same everywhere. Okay. Then we wanted to looking at some of the competing narratives surrounding business. So this is the first time that I start to introduce the idea of a narrative, which is a cultural artifact. Stories, discourses, it's the same thing. Narrative, stories, discourses. It's the things that we say to each other. Okay. Language surrounding business, markets, and economies in order to be able to accurately define the associated terms. Start to think about the terminology that we use in business and describing economies. So what does it mean? What do these mean in real terms? And develop more strategies for critical thinking where exploring assumptions connected to a subject. Is that there is a danger that what we try to do is apply a one-size-fits-all to the various solutions, and to say that economy tends towards our models, or does the models shape the economy? Now, this is a difficult point, and I understand that. But the view that we have here is that narratives, stories, and discourses shape the economy. Again, relating back to the other one, economy is not something that sits outside of us as a society. Society shapes economy just as much as economy shapes the individuals that's within it. Okay, it's not something that sits out there over there that is and needs to be understood, therefore, within our context of social shaping. We say social shaping of technology, but what if you applied that social shaping towards economy and business of itself? Because who's doing it? It's people, isn't it? People are the agents of our economy. Now, the deterministic view is that under axioms, under assumptions of economies, that we all behave in certain ways. But why don't we? Why do we behave differently? How can we understand that? How can we think about that? Okay, so that's what this does. This raises questions about the notions of business, international business, economy, and globalization per se as a convergence, and bringing it the same as this interconnectedness. So we talked about varieties of capitalism as a set of theories. We also talked about perspectives that underpin capitalism as a business model, as a business system. And we talked about globalization as a foundation for a cultural appreciation of international business. That's the elements of narratives that are within there. And the two readings that I gave you here are quite difficult. And I know that. But nevertheless, is that you really ought to spend some time trying to address those particular readings in order to understand how the cultural impacts upon the business upon notions of capitalism, and then more readily upon these notions of capitalism, of globalization, globalized capitalism, globalized business. Okay, so it's quite a complex situation here, but understanding the role of the culture within business is what we're after. Okay, or having an awareness of the role of culture in business is that there is a tendency to say, well, we'll just look at the numbers. That's all we need to know. That's not quite the case, is it? All right, so that's 2. Any questions on that one? Okay. 3, we talked about money and the role of money in the economy. Now, this is where we start to look specifically at financial innovations. We have looked at the economic system, the business system, the international business element of it, if you like, and now we're moving on to dealing with money, financial innovations. And when we start to look at finance, is that there's lots of financial innovations, but before we understand those or think about those, we really need to understand the role of money within society and the role that those strange businesses out there called banks, the impact that they have on our economy as well. So specifically, we're looking towards an understanding of the role of banks in the economy, to discuss and to appreciate the 3 contrasting models of banking as outlined in textbook banking theory. And there are 3 models, and they're not, is that firstly, is that you've got banks as financial intermediaries, then you've got the fractional reserve banking models, and then you've got banks as the producers of credit. Okay. Gain an appreciation of the complexities surrounding money definition and start to appreciate money as a social relationship. What is money exactly? The difference between money and credit. In practical terms, when people put money in your account, do you know that that's actually money or whether it's credit? i.e. it's a loan, or it's somebody that's taken out a loan and passed it on to you. Does it suddenly magically change from money into credit, or does it always stay as being credit? But it doesn't make any difference because it doesn't matter, because people will accept it. So why do they accept it? It's because people trust the value that's within it. So there is a perspective here that we've started to develop, whereas money can be seen as either a commodity, and it tends to be seen as a commodity within economics. But as you remember, when we looked at the theories, it has a money as a commodity. It's a special kind of commodity in that it's neutral. Credit is not neutral. Credit drives the economy. And that as banks issue credit, credit is issued in order to be spent. And it's the spending of credit that drives the economy. Credit issuance, if you like, is a good proxy for aggregate demand, which is completely at odds to the story of money being neutral. And there's an argument to be had for both. However, empirically, we'd have to suggest that actually money as being something which is neutral is problematic. And then also within money definition is that there are lots of different, there's M0, M1, M2, M3, and M4 in certain economies. What do they all mean? And are they relevant? They're relevant to banks and bankers, but are they relevant to people within a wider society? Where does money come from, then, in other words? And we know that a certain percentage of money comes from the central bank in either bank reserves, central bank reserves, or coins and notes. But the rest of it, the bulk of it, probably 95% of money, certainly more than 90% of it, the bulk of money is created by commercial banks in the form of credit. And that drives our economy. Okay. So the key concepts we wanted to address here was banks as the producers of credit as opposed to the other two models. And that's interesting as well, because that's the oldest theory of banking. And so therefore we might want to ask the questions is, why were they displaced by models of banking that don't appear to correspond to reality? And that's because the models of banking as banks as intermediaries is that corresponds to an orthodox thinking about money in the economy. Banks are just intermediaries. They just pass on savings in the forms of loans. When banks actually generate the money supply, that's quite a substantial difference. I've talked about money as a commodity or relationship based upon trust. Again, there's arguments for both, but which one corresponds to our lived realities? Credit drives the economy. And the key reading for that one is Richard Werner's paper, is Can Banks Individually Create Money Out of Nothing? And the reason that that's there is because that is empirical evidence of banks creating credit, which drives the money supply. Following on Werner's paper is that the Bank of England also acknowledged that banks create money through issuing loans, and other central banks have done too. Okay. Taking our story of money a little bit further on then, and then we looked at the notion of financialization. Specifically, financialization is not a thing, it's not a strategy or a tool to be put in a manager's toolbox. Is that managers up and down the country don't talk about financialization. Financialization is an observation of connected or of an observation of connected behaviors related to finance, that we've brought them all together to talk about finance and financialization. Okay, so what role is finance having on business and on wider society? Okay, so we wanted to develop a definition of financialization as used in contemporary capitalism, and this pertained to the size of the financial industry related to productive economy, and also there was a time element that was put onto it as well, is that financialization appears to have been developed out of or from the 1980s, the early 1980s, when there was a change politically and a change economically, and that we moved into an era of free market capitalism where the self-correcting market is dominant. In other words, we should organize our societies around the economy. And as a consequence of doing that is that you deregulate and you liberalize the markets, and particularly markets of finance. There's an acknowledgement that finance has a benefit to economy and to business. And in order for us to fulfill that, we need to deregulate it because markets self-correct. So can we consider two themes of empirically observed examples of financialization: the size of the financial sector and the financialization of the household specifically, in that financial assets and debts dwarf the size of the productive economy. Now, I think, remember at the time, as I suggested, that Keynes acknowledged the value of finance, but said that they were the froth that sat upon the productive economy, i.e. finance serves the productive economy. What happens when finance serves itself? Okay, and that banks use huge amounts of liquidity in order to be able to trade for their own benefits. They are placing bets and investments, speculation, in order to generate profits for the banks themselves. Investment bankers don't work necessarily specifically for clients, but they might well work in their own interests. Householders tend to be at the other end of the spectrum, because householder debts, financial assets, fund the banking industry through what I refer to as a coupon pool. Now, what that means is that every time that you buy a financial product is that you pay for it on a monthly basis, either through interest payments or through fees or whatever it is. That creates a cash flow and contracts that can be exchanged on secondary markets and are valuable. They're what's known as fungible. i.e. that they are transferable and tradable. Okay, so when we take out a loan, is that I'll sign a contract for that loan. That loan can therefore be traded, can be sold on. The contract itself is sold on. And we talked about the process of securitization, if you remember that at that point. That securitization process is the bringing together of different contracts and then selling them on to a third party. Excuse me. So this was to extend your understanding of the role of the banks and to add the variable of power. Because if you remember, back in the globalization lecture, we talked about transformationist perspectives, which relates to the power. Who holds the power in our globalized economy? And here what I'm doing is explicitly suggesting that banks have got a disproportionate amount of power because they are providing us with the source for economic growth. They are the agents of economic growth through the provision of credit. But credit does not necessarily need to be paid or does not need to be produced specifically for productive growth. What can credit be produced for? Three things. One, it can be spent. If it's spent on consumption or for invested into productive growth, that's a positive thing. It can also be used to pay down existing debt, which means that that actually creates a gain in income for whoever has paid the debt down. So if I have a mortgage and I pay down a chunk of my mortgage, I'm paying less debt on a monthly basis, which frees up my amount of income that I can spend on something else. Or the third thing is that you can use the credit creation in order to be able to fund speculation. So banks, therefore, are very powerful. And that's the rationale behind it. Key concepts: financialization as a contemporary phenomenon, or financial capitalism, which you talked about, many of you, which is fine. There's a shift, therefore, from production to financial production, financial markets. We also talked about shareholder maximization, shareholder value maximization, is that firms and banks that are held or that are governed by shareholders want returns on their investments. So that large firms are competing in a stock market for shareholder value. And that relates to this notion or this thing that we've called agency theory. Agency theory is, how do owners of companies get managers to work on their behalf? So if I'm the owner of a company and you guys all work for me, how do I get you to work for my benefit rather than your own benefit? And one of the ways we do that is to give the senior managers shares. They become shareholders. But then that might have resolved the agency problem, but it's created another problem. Short-termism, lack of investment, free cash flow going back into rewarding shareholders through either things like dividend payments or share buybacks. A share buyback where the firm enters the market to buy its own shares back and therefore it increases its own share price. And I gave you a couple of readings on that one. Natasha van der Zwan's paper on making sense of financialization, which is, to be honest, not the easiest book, the easiest article in the world to read. Also, I gave you Rosenzweig's article on the halo effect and other managerial delusions, because on what basis are we attributing success? That's the question that Rosenzweig asks, is that how do we attribute success? So if a firm works well or is working well, how do we know what's caused that firm to work well? And that's the challenge that Rosenzweig highlights. And he talks about halos and how narratives can drive our sense of value and what's important, stories. And then also I've given you Joseph Schiller's work, which underpins this idea about narratives driving value. And he gives you some examples in his book about how this does this. And I think the Bitcoin chapter is really interesting there. And I think that what you should read in terms of those elements is that the introductory section to van der Zwan's paper, the first chapter on the halo effect in Rosenzweig's book, and just the introduction and or the Bitcoin example in Schiller's book. But again, so the linkages from this is innovations, culturally driven, driven by narratives which actually are subscribing value. Yeah. Which is socially determined, socially shaped. They're not sitting out there. Then we moved on to bubbles and crisis. The learning outcomes here was to be able to understand and explain the concepts of conjuncture and bricolage, which is a difficult one, I know. So for the benefit of the doubt is that conjuncture is a portmanteau word between cojoin and junction. All right, so that's the bringing together of lots of different factors which are socially shaped in order to work together to create a unique time and space. And the way that people then respond to that time and space is through the bricolage. Because it's unique, you can't define anything in advance of that conjuncture. You can only use the existing tools that are around at the time. And how you might use those tools can differ. Okay, so as an example of that, we talked about the global financial crisis and how bubbles are created. And the conjuncture at that time where lots of different agencies got together, not knowingly, almost by accident, to create something which was unique in times and space, which allowed finance to create mortgages, mortgage-backed securities, and then collateralized debt obligations. And that's the bricolage. And then you add into it the fourth one, if you wanted to, which was the CDSs, credit default swaps. You don't need to understand the mechanisms between how all of that worked, but effectively what it is doing is that they're bringing together contracts and collecting them together and selling on those contracts to somebody else. And then doing the same again, and then the same again. So conjuncture, according to Yusuf, is literally the expression right time, right place, right time. No, I don't, because that's determining that it's right. There's not a right, it's just time and place, I think. I won't say right place, because that's kind of like indicating that there is an element of correct. Yeah, it's just what is, and how do you do, as opposed to us trying to think about, well, time and place doesn't matter in innovations, is that this is putting time and place right in the focus of it, but understanding the conjuncture is important to understanding the kinds of innovations that come out of it, and therefore the effects those innovations have on business and on society. So that's about appreciating the complexity of the innovations. But descriptively, mortgages, mortgage-backed securities, collateralized debt obligations, CDOs. And then in the face-to-face session, we actually saw that that same kind of behavior is starting to occur again as finance is collateralizing corporate loans and corporate bonds. You simplified it way too much. Well, I don't know whether you simplified it way too much, but I think that understand that it is a complicated expression about how different socially derived dynamics and variables come together in time and space to create an opportunity, or, remembering Beck, an opportunity or a fragility. Yeah, is that as you create more and more mortgages for people to be able to own their own homes, and then you seek to extend it, is that you're starting to use mortgages in an inappropriate kind of way. So it's complex, and I know that, and I get that, but you don't need to understand the underlying how it all occurred. It's a descriptive process, and that's fine. So therefore, that leads us to think about different debates about financial innovations. Is that, does financial deepening and the widening of finance, does this create a self-correcting equilibrium market, or does it actually create long chains of debt that actually causes financial bubbles and financial crises? And then more latterly was to be able to understand and explain Minsky's instability hypothesis, which is in essence 3 stages: the conservative stage, the speculative or exuberant stage, and then Ponzi financing. And at the Ponzi financing period is where money is being borrowed and paid back out of the growth of the assets that they bought. So in other words, at the global financial crisis, people were borrowing money in order to originate mortgages and then paying back the loans out of the profits they were making from their mortgages. And that's what Minsky describes as being Ponzi financing. And it only takes the failure of people to pay the mortgages back when you're going to start to get a financial crisis. And the financial crisis starts to affect the real economy when credit slows down because the banks stop lending to each other and to clients. That was the credit crunch. And the readings, the key concepts here are conjuncture and bricolage, mortgages to mortgage-backed securities to CDOs. What value is financial innovation? There's an argument for both. And then Minsky's financial instability hypothesis. And I gave you the two readings about the financial instability hypothesis from Minsky himself, and also a difficult paper. And I understand it's a difficult paper, but nevertheless, is that you are in higher education, reconceptualizing financial innovation, frame, conjuncture, and bricolage as being the core readings for that particular unit. 6, last one. Crisis and correction. So we took the story of the financial crisis and we looked at what happened after it. We talked about the credit crunch and how financial innovations promoted fragilities, long chains of debt, in other words, in the global financial system. It's quite amazing, isn't it, that actually dodgy mortgages that were taken out in America impacted upon the global financial system. So there must have been long chains of people buying and selling these things, all of which have got debts within them. Then we moved on and so understand the basics of unconventional monetary policy enacted by central banks and financialized economies as a consequence of the global financial crisis, interest rate reductions and quantitative easing, which is the wholesale provision of liquidity back into the financial sector, on the view that reserves of liquidity stimulate lending, and that's the transmission mechanism. Have an understanding of the effectiveness of interest rates and monetary policy, i.e. what I've just described. Did it work? Well, given the $37 trillion that were invested into the economy in terms of additional liquidity, it's a judgment call as to whether or not you think it was effective. 2% growth globally for 37 trillion doesn't strike me as being a very good investment. Understand how the conjuncture typified by global production of excess liquidity fueled financial markets, i.e. the conjuncture shifts at this point. You get cheap money, lots of liquidity. Where's it going? Remembering it can only go to one of 3 places. So as a consequence of quantitative easing, investment into business stays flat, but investments into stock markets and securities escalates dramatically. And we see the stock markets get to the highest point they've ever been. And that behavior has been replicated by COVID-19 too, the crisis in the pandemic, in that stock markets are now at their highest level, despite the fact that global economies are slowed down or are in recession, which makes us ask some questions about what stock markets are about. What are security markets about? How do people make decisions about where to invest in stock markets? And that comes us back to the narratives. Narratives drive value. Remember Minsky's idea about markets being beauty parades? It's not about selecting the most beautiful. It's about selecting the one that everybody else thinks is the most beautiful, because that's where the money's going. And if the money goes towards an asset, it has to go up in value because nothing new is created. Like a balloon, money pushed into a balloon. So you imagine that everybody's buying corporate bonds, is that we're investing money, that's the air that goes into the balloon, the size of the asset bubble goes up, has to, nothing new is created. I have to qualify that a little bit in terms of corporate bonds, because if the corporation is borrowing money in order to be able to invest, then something new is being produced. If, however, it's just borrowing money in order to buy back its own shares, then nothing new is being produced. It's just stimulating the share markets. Key concepts about monetary policy after the crisis: transmission mechanisms and central bank policy. This is about reserves driving increased liquidity, increased reserves driving lending, and quantitative easing. And then the current conjuncture, and then as by association, can we discern what the current bricolage is? What's going on? And when we looked at, I think it was Renison's article, I think that's the guy, the name, we talked about collateralized loan obligations, corporate bond issuances. And this was the start of the current conjuncture. And where does that lead us to? Well, if you accept Minsky's view, is that leads to conservatism, and then you lead a huge growth in that industry or those assets, which is the exuberant bit, which is probably where we are now. And if Minsky's view is correct, is that we might see Ponzi financing. Apart from the fact that Minsky's view, is it deterministic or is it socially shaped? So we can stop it at any point, but it just means that we need to look at the right data and say, perhaps this is getting out of hand. But you wouldn't do that if your view was that markets self-correct, move towards equilibrium. There's no need to do it. The market does it itself. Evidence must suggest that that is a problematic view of finance. And I gave you one reading there, which I think is a really nice reading, actually. It's quite technical, but it does explain the various strategies of quantitative easing. And it's much better than Richard Werner's work on quantitative easing, but he was the guy that pioneered the topic. But I like Fawley and Neely's paper, 4 Stories of Quantitative Easing. So as I said, I was going to run 4 more catch-up sessions where I'll cover in more detail the various topics that we've talked about today and that we've covered so far in this semester. And the dates are here, look. Thursday the 26th, we'll talk about technology and innovation. That's this Thursday coming up. Thursday the 3rd, I'll talk about money banks and financialization. Thursday the 10th, I'll talk about conjuncture and bricolage of the global financial crisis. And then Thursday the 17th, we'll talk about quantitative easing and central banks. Okay. All of those will start at 8 o'clock in the morning, so I apologise for the inconvenience, but actually for some of you that are in Asia, then this will be more amenable to you. They're not compulsory, but if you want to attend them, I shall look forward to seeing you then. Okay? And I think that effectively brings to end today's session. I shall see you all very, very soon. Take care.